Over the past decade, there has been a handful of stocks that have really outperformed the market from a share price appreciation standpoint, but also from a dividend growth standpoint. And one of those companies is Home Depot, stock ticker HD, currently trading at $300.81 per share. Like I said, you can see over the past decade, they're up around 288%, but year to date, they're actually down around 4.78%. Now, the company has a pretty decent starting dividend yield, sitting at 2.78%. You might not think that's a large amount, but if you look at the dividend growth over the past few years, if you look at the 3-year dividend growth rate, 11.74%, 5-year 15.75%, and the 10-year sitting at 19.36%. With dividend growth rates that high, a dividend yield sitting pretty close to 3% is actually pretty solid. And when you look at the dividend yield, you can see the 4-year average dividend yield sitting at 2.26%. That starting dividend yield right now is actually quite a bit higher than its average. Now, when you have a really quality dividend growth company, to help you better understand how important the dividend growth is, one of the things that I like to look at is dividend yield on cost. This is going to help you understand why dividend growth investments become so effective long term. And keep in mind, this doesn't account for reinvesting your dividends. But you can see basically if you invested in this company, 9, 10, or 11 years ago, your dividend yield on cost would be sitting close to around 11 or even 12%. Again, that is the compounding effect in place. When you invest in companies that continue to increase the amount they pay in dividends, year after year, you really start to get really high dividend yields on cost. And again, I want to point out again, I already mentioned it, but that doesn't even include reinvesting dividends. If you reinvest dividends over that time period, who knows, it could be closer to even 20%. But if we jump back over to our summary tab, again, I want to point out, like I said, they're down almost 5% year to date. So in this video, we do need to answer the question, is the company currently trading at a good value where we should consider adding shares of it to our portfolio? So we're going to be jumping into my stock valuation spreadsheet and looking at a few different valuation models like we always do to see if we can find the intrinsic value. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. But okay, let's go ahead and come up here and plug in the stock ticker Home Depot and hit enter, and you can see all of this data will automatically load in. Now, like I already mentioned, dividend yield sitting at around 2.78%, dividend payout sitting at around $8.36. Now, the payout ratio is sitting at around 47.3%. Payout ratio is a metric that a lot of people think they understand, but more people need to understand the implications of a high payout ratio. A high payout ratio does mean that it's harder for them to continue to pay out those dividends, but it also means it's harder for the business to grow as a whole. They don't have a lot of money left over to reinvest back into the business, which means the business won't see much share price appreciation. But in this case, payout ratio is sitting at 47.3% for a company like Home Depot. Not really a red flag for me. I think Lowe's has a little bit of a lower payout ratio, so I think we could see more dividend growth from their competitor Lowe's, but overall they do have a nice starting dividend yield, and I think we'll continue to see pretty solid dividend growth over the next decade from them. If we come down here, we can see analysts currently have a target price of around $314 per share, institutional ownership sitting at around 71%, and a beta of 0.93, so the volatility levels should be a little bit lower than that of the market. If we look at our first valuation, we're going to be looking at Graham's valuation. This is a valuation model invented by Warren Buffett's mentors, Benjamin Graham, and here's the formula he lays out for us to calculate intrinsic value. So the first thing we're going to take is our earnings per share, and in this scenario, we're actually using the forward-looking earnings per share of 14.95. We then multiply this by our growth rate projection, and if you look at analyst projections, Home Depot is still projected to grow at a pretty good rate over the next few years. We have 14 for our growth rate projection. We then multiply that by 4.4, which is the average yield on AAA corporate bonds, and then we divide by Y, which is the current yield on AAA corporate bonds. And at the time of this video, it's again sitting pretty high due to economic conditions at 4.64, which will drive down this valuation quite a bit. But with all of this being said, we still come to an intrinsic value of $297 per share, right at the current trading price of $300 even. So under normal market conditions, usually that current yield on AAA or corporate bonds will be a little bit closer to 3.5. And if that was the case, you can see the intrinsic value jumps up quite a bit. But again, due to those market conditions, intrinsic value sitting at $297 according to Graham's valuation. Now the next valuation model is one of my favorites, especially for Home Depot, and that's the discounted cash flow analysis. Home Depot has proven to be a free cash flow beast over the past decade. They have rapidly increased their free cash flow, which is a big reason we've seen so much share price appreciation and also so much dividend growth. And moving forward, I'm actually projecting a free cash flow growth rate of 11% moving forward. That's pretty close to their average growth rate of around 12% over the past decade. But again, I'm projecting 11% for the next decade, and the terminal value, which is the sum of the future free cash flows past the year 2030. I then found the present value of those future free cash flows and added them together, added the company's cash and cash equivalents, subtracted out their total debt to get their equity value. Once I had equity value, I divided by shares outstanding, and I came to a discounted discounted cash flow price per share of $326 per share, so a little bit higher than the current trading price and a little bit higher than we got for Graham's valuation. But the next valuation model is a little bit different, and that is the multiples valuation model. And basically what it does is it values a company based on how the market is valuing companies that are similar in structure. So obviously the best example we have for this would be Lowe's, and you can see they have a price to earnings multiple of 20.96. If we jump over to our stock screener, you can see Home Depot's price to earnings sitting a little bit lower at 18.32. And if we jump back over to our others, you can see we have FND, LESL, and the average price to earnings for these companies sitting at 23.58. So when we have that number, we multiply it by Home Depot's earnings per share, and we come to an intrinsic value again, $307.47, slightly above that current trading price and pretty close to what we got for the other two valuations. But the last valuation model we're going to look at is the dividend discount model. But first, I'd like to say thank you to NordLocker for sponsoring this video, which you can get a 3-month free trial to at my link in the description. One of the current biggest threats to business owners is keeping their confidential data safe and secure. In fact, I've personally seen how important keeping your data safe is, as a family member of mine recently had some of their confidential data stolen. As a small business owner myself, I know it's extremely important to take steps to keep my data secure, and that's where today's sponsor, NordLocker Business, comes in. NordLocker Business is an encrypted cloud storage platform for storing, sharing, and managing business data securely. Developed by cybersecurity experts, it ensures business files can be accessed anywhere and anytime, but only by authorized parties. With NordLocker, you can get encrypted cloud storage, team management, you can utilize an easy-to-use drag-and-drop interface, secure file sharing, data backups, and NordLocker can be synced across Windows, Mac, and Android devices, all with a simple-to-use interface. You can get a 3-month free trial to NordLocker Business at my link in the description. And this values a company based on how much they pay out in dividends and how much that dividend is increasing over time. So I plugged in the quarterly dividend payouts over the last few years so we can see how much their yearly dividend payouts have been, and more importantly, those year-over-year dividend increase. And it's been right at 10% for a lot of these years. You can see 10.29, 10% even, 15.15, and then 10% the most recent dividend increase. So a really nice average growth rate over the past few years of 11.36. And moving forward, I'm projecting a dividend growth rate of 6.5, discount rate of 9%, and that gives us a dividend discount model price per share of $356.14. So when we jump over to our output tab, we can see our 4 valuations: Graham's at 297, multiples at 307, discounted cash flow at 326, and dividend discount model at 356. All these valuations are fairly close to each other, as you can see, but when we average them together, we come to an intrinsic value of $321.82. Current trading price for the company sitting at around $300.81. So there's a difference of around 6.5% between the intrinsic value and the current trading price. But with a 10% margin of safety, you could see our acceptable buy price for the company sitting at $289 per share, and with the 20% margin of safety, it's sitting at $257.46. And if we jump back over to Seeking Alpha, which by the way, you can get a 14-day free trial to at my link in the description, but if we look at the past year, you can see there have been opportunities in those lower price range. The 52-week range, the low is sitting at $265.61. So it hasn't been too close to that fairly recently, but there were opportunities in 2022. But again, it has gotten as low as around $280 or $275 per share within the last 6 months or so. So again, when you value companies, be sure to add them to your watch list and set alerts for when it does hit your buy range. That's one of the strategies that I personally use. As for me, I don't currently plan on adding shares of Home Depot to my portfolio. I have a good bit of Lowe's. I like them a little bit more from a dividend growth perspective right now. If you're interested in seeing a video where I compare Lowe's and Home Depot and which one I like a little bit more, go ahead and let me know in the comments down below. But there you go, there's a quick analysis on Home Depot. If you'd like to be able to download the spreadsheet, then you can head over to my Patreon page at the link in the description. So with that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.